Good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we start off this week where the markets have largely been range bound since we broke out here above the all-time highs, call it the 610 level here. After we broke out, we've spent the last week or so really consolidating. And this week, we're finding ourselves opening up again higher. So we've gotten the rally, we've consolidated, and now we're continuing to move higher. That is, generally speaking, a positive sign here. It seems like based on the earnings this morning and news last night from NVIDIA has pushed the markets higher here. JP Morgan did report decent earnings, but the stock's down about 1% pre-market here. But the numbers that we saw out of investment banking from JP Morgan was relatively stronger than expected. So it seems like the overall kind of economy, or rather um, the outlook on the economy has turned a little bit of a corner here, and we'll see kind of from the earnings this week whether or not that's being confirmed or not. But early reports last week with Delta coming in surprising to the upside, speaking about the fact that consumers have seemingly um, uh, consumers have become more optimistic about the second half of the year and their travel plans. We saw the news out of JP Morgan just a few minutes ago with regards to their earnings report. And equity markets kind of reaching new all-time highs has really given a lot of investors a lot of confidence in this current market rally. The only thing I think worth pointing out is the fact that while corporate earnings, while the S&P 500 measured by the index continues to perform incredibly well, if you look at the economic numbers coming out, it's been um, somewhat on the softer side. We continue to see kind of employment data coming out softer than expected. We've seen consumer sentiment and consumer spending become quite surprised to the downside. And these are all concerns for a lot of people with um, regards to the overall economy. So I think that's really kind of the most important thing to be paying attention to here right now with regards to just the starting to see a bit of decoupling with what the equity markets are telling us versus what the economic numbers are coming out with. And to be frank, the economic numbers could very much turn around, and because equity markets are forward-looking versus economic numbers are always, lagging behind in terms of the data. So it very well could be that the economic numbers haven't caught up yet to the reality of things. So that's kind of what we're paying attention to here right now. We're seeing that on the S&P 500. We're also seeing it on the Nasdaq 100, where you see that um, you see that we've broken out to new all-time highs, and today we'll open up at all-time highs again here on the Qs, and that was after a breakout to new all-time highs, consolidating for about a week or so, and now we're seeing that continuation higher here. That's a pretty strong confirmation of this breakout, that there are legs to this particular breakout and it can continue. And we've seen it on the major mega cap indices. We look at small caps, IWM. We're seeing similar type price action here on IWM. You have, basically a breakout here to new recent highs, a bit of a consolidation, and we're looking for that continuation higher here as well. And whoops, did not mean to do that. And you also see it on RSP, equal weight S&P 500 index. So that's really where, overall the equity indices all are telling us similar story. And the good thing about RSP, the equal weight S&P 500 index, is the fact that the equal weight index is also continuing to push towards these all-time highs. And that's a really good sign, because that means that it's not just the mega cap tech names that is moving the markets, right? That we kind of have a broad participation. We are potentially seeing RSP, the equal weight S&P 500 index, reach all-time highs within a few trading sessions here to the upside. The all-time highs on RSP is around 188. We're trading at 184 right now. So we're very close to the all-time highs for RSP. So we'll continue to monitor that. Overall, if you look at the bond market, HYG, high yield corporate bonds, has shown a fair amount of strength here as well in this current market, as we continue to see high yield corporate bonds continue to move here to the upside, continuing that risk on signal here. The only thing that we have to be cognizant of, in my opinion, is treasuries. A couple of months ago, we saw the Japanese bonds kind of sparked a bit of a sell-off here in treasuries, and we're seeing that again here in treasuries again, right? We've seen this rally here in treasuries over the last, call it, month and a half. That's kind of fallen apart a little bit here in the past week. So yields have risen again here on 10-year yields. We're seeing 10-year yields, inching back up towards that 4.5% level here again. If we see treasuries continue to sell off, or where investors are more concerned about just the rising level of debt that the US is heading towards, this is one of the things that I think could derail the equity rally here, even though at the moment equity investors have largely shrugged off this concern and risk. And I would say even treasury investors have some degree shrugged this off. But treasuries remaining closer to 52-week lows shows us that investors are concerned about kind of the sustainability of the amount of treasury debt that is outstanding. So this week, obviously, we have a big week for earnings. JP Morgan reported this week. You have Bank of America, Goldman Sachs tomorrow. You've got Netflix, Pepsi reporting on Thursday. So you have some big names reporting this particular week. That's going to give us a good sense for kind of the health and the outlook of the consumer in the second half of 2025, which is going to be a pretty significant, I would say, part of gauging investor sentiment going forward. So I think this earnings season is going to be a really important one to pay attention to, specifically looking at the underlying numbers, looking at the earnings transcripts and kind of what CEOs are actually saying about their business and their outlook for the business, because I think that's going to provide a lot of insights into how the second half of this year is going to shape up. So looking at ideas here for this week, we don't have any new ideas here for the week. Looking at kind of how the markets have stagnated a little bit here, we've taken to be a little bit more conservative in taking new positions here. But one of the trades that we still like here is XYZ, which is Block, formerly known as Square. The symbol for that was SQ. So the stock or the company rebranded from Square to Block, and they changed their symbol from SQ to XYZ. So if you're not familiar with this particular symbol, that's why. And as you can see, this stock recently broke out here above this, call it $65 level here. It broke out here to the upside, came back to retest this as support, and is now moving higher from here. And what I like about Block is that it's trading around 14 times forward earnings, which is a pretty significant discount to the industry, especially if you consider the fact that Block is growing faster than the industry and is more profitable than the industry. So the fact that it trades at a discount, at a valuation that's nearly half what the industry average is, represents what I believe is significant upside potential. So this is really where I would look at maybe buying a call or even a call spread potentially to capture that upside potential with limited risk here to the downside. The stock was down 5% on Friday, but back up again 5% yesterday, really kind of erasing some of the losses here from Friday and more and really, I think is setting itself up nicely for further upside here. And the next one I want to take a look at is Norfolk Southern. Which is a railroad stock, not a particularly sexy stock to look at, but recently has performed incredibly well here in this particular market, trading at around 21 times forward earnings, which is quite in line with the industry. The industry is trading at around 20 times forward earnings. And if you look at growth expectations for the stock, it's pretty much in line with the industry. EPS growth outpaces the industry by a little bit, but where it really excels is profitability. Norfolk Southern net margins are north of 27%, versus the industry average is around 6%. So we're looking at an industry a profitability that's head and shoulders above the industry, and that's why when it trades at a valuation that's basically in line with the industry, but it's far more profitable, that's really where I believe there's a fairly significant amount of upside in this particular stock. The next one I want to take a look at here is Alphabet. We've been talking about Alphabet here for a few weeks now. And this, we went long this stock basically as it pulled back here to, this particular trend line. These were great potential entry opportunities to take a bullish position. And this was the one where we laid out kind of a bullish thesis to all of you here. And just yesterday, as you can see, after kind of testing this 180 level a couple of times as resistance, it looks like we're starting to break out here to the upside. So you've kind of got this trend or wedge channel, however you want to call it, whatever formation you like to call it, that looks like it's on its way to breaking out. And you have this gap here at around 2202. That would be our upside target here for Alphabet. And Alphabet trades at a very reasonable 19 times forward earnings, which if you consider the fact that its growth expectations are basically in line with the industry, but net margins far exceed the industry, we're talking about net margin of 31% versus the industry average is around 6%. So when you're far more profitable and you're trading at a valuation that's actually below the industry average, that's really where we believe that there's a strong fundamental reason to be long this particular stock. And then from a timing perspective, right now looks quite interesting on that particular breakout. The next one I want to take a look at here is Target. We've been talking about this retailer here for the last couple of weeks. Effectively, the Target has had a compelling valuation for a while, but just because it has a compelling valuation doesn't mean that now is the right time to buy it. So as you can see, if I just zoom out a little bit, this stock, went from $175 stock back in mid 2024 down to, a sub $90 stock here in April of this year. So in the last couple of years, the stock has lost basically 50% of its value. But after that, as you can see, it's been trading sideways here for the last 3 months or so. And at the beginning of June, as you can see, the trend quality really started to improve, where it was kind of very choppy, kind of turning between bearish and bullish and neutral to solid bullish and neutral here for the last, call it, month and a half. And also it kind of broke out here above this $100 level that has been resistance for a couple of months, broke out, retested it as support, and is now potentially starting to trade higher from where we are. So our upside target here for Target is 130. So we have a plenty of room to grow here to the upside. And Target trades at a very, like I said, a compelling valuation around 14 times forward earnings versus 18 for the industry. If you look at growth expectations, we're pretty much in line with the industry. The only thing that Target has is a little bit behind on is revenue growth expectations. But net margins of 4% actually exceeds about 75% of its peers. So this is a company that we really like from a fundamental perspective, and the timing on it just wasn't right. But recently, in the last couple of weeks, this is looking a lot more compelling from a timing perspective, and that's why we started to add Target here to our list. And the last bullish idea I'll leave you with is Micron. We just saw the news this morning out of NVIDIA with regards to resuming their H20 chips to China, and the stock's up nearly 4.5% here today, or pre-market. Micron is up about 1.5% pre-market, and Micron supplies a lot of the high bandwidth memory chips for NVIDIA GPU chips. So it's a very um, it's an indirect way to invest in the AI infrastructure build out versus kind of less obvious ways through like in more obvious ways like through NVIDIA. And Micron trades at a very reasonable 10 times forward earnings, and if you look at growth expectations, we were talking about growth expectations that rival NVIDIA. It's not as profitable. Net margins around 18% versus 55, 51, 52% for NVIDIA. So it's by no means, anywhere close to NVIDIA, but it trades at 10 times forward earnings versus NVIDIA is trading at 38 times forward earnings. So Micron is an interesting alternative to get exposure to AI infrastructure versus NVIDIA. And then looking at some bearish ideas, Tesla is at the top of my list here for bearish ideas. Essentially, the stock, as you can see, has continued to trade lower here. And the fact that we've kind of traded lower here and recently rallied up to that 315 level actually generates a potential sell signal here. So we actually have a sell signal that it just generated here today for Tesla. And Tesla trades at 166 times forward earnings, which is just incredibly expensive for the particular stock, especially if you consider that growth expectations, yes, it exceeds the industry in terms of growth expectations and profitability, but trading at a valuation that's 15 times higher than the industry is really hard to justify by any accounts, right? We can say that Tesla is more than just a car company, that it's a battery company, it's a robo-taxi company, it's a AI company, it's a tech company. All of these reasons, could be justified to validate a higher valuation, but we're still talking about a valuation that's 15 times higher than its industry peers. And for those reasons, it's really tough, in my opinion, to justify those types of valuations. Whoops, sorry, didn't mean to close that out. The next one I want to take a look at here is Walmart on the bearish side. Walmart, in my opinion, is sort of like the counter to Target. Very similar fundamentals, like all of these big box retailers have very similar fundamentals. Walmart happens to trade at 38 times forward earnings versus Target is trading at 14 times forward earnings. So you're talking about a valuation that's double what Target's trading at. My downside target is not super aggressive. It's only $91 to the downside. But it's because Walmart has, like I said, compared to Target, fundamentals that don't look very different. The only thing that's different about Walmart versus Target is that revenue growth is expected to come in around 4% versus around 2% for Target. Is that enough of a difference to justify a valuation that's double the other? Not to mention that Walmart's profitability is actually significantly lower than Target's. Target's net margins are around 4%. Walmart's around 2.75%. So that's a meaningful difference in terms of profitability. And yet Walmart trades at a valuation that's double what Target is. So which is why I have a bearish view on Walmart and a bullish view here on Target. Apple is another one that we've maintained a bearish view on here for quite some time. Apple continues to trade at a valuation, in my opinion, that is quite unreasonable. And recently, as you can see, it's been really struggling with this. Whoops, this is the wrong symbol. Very similar chart, wrong symbol. So as you can see, Apple's really struggled with this 215 level here for the past few months as a resistance level. And it recently just tagged that level here last week. And I think that was a good opportunity to potentially add some short exposure in this particular stock because it trades at 27 times forward earnings, which is just incredibly high for the business. Growth expectations right now have come down meaningfully in the last year. We're looking at expecting only about 5% revenue growth and EPS growth of around 8%. Net margins have remained fairly stable around 24%, and that is what justifies a more premium valuation because it's more profitable. But when your growth expectations continue to decline, that's really where this valuation becomes harder and harder to justify. As you can see, the stock clearly has underperformed the S&P 500 by a pretty significant margin here over the past year or so. So for those reasons, I don't particularly see a reason that Apple's going to turn things around in the very short run, which is why at the moment I'm still maintaining a bearish view here on Apple. And the last one I want to take a look at here is T-Mobile. T-Mobile trades at a valuation that's basically double the industry average, which is around 10 times, versus T-Mobile trading at a valuation that's 22 times forward earnings, so more than double the industry average. Now, T-Mobile does grow faster than the industry and has higher net margins by a small amount. So it arguably is justified to trade at a higher valuation, but none of these metrics are high enough, in my opinion, to justify a valuation that's more than double the more than double what the industry is trading at. So for those reasons, I believe that there's definitely some potential downside here for T-Mobile when it's trading at such rich valuations. So that's where we are here at the moment with regards to the market. We clearly see that the valuations here across the board for a lot of stocks remain fairly elevated. At the same time, there are some really interesting, compelling opportunities here to the upside. So as markets reach all-time highs, there's definitely two sides to the views right now as to whether or not these highs are sustainable or we're likely to see some further upside. So hopefully, you have some opportunities on both sides that you can play here for the week, utilizing options, and you can use options play to help you structure those options trades. With that, thank you so much. Hope you guys have a great trading day, and I'll see you guys here next week.